everyone. I hope you're doing so well. Today we'll be talking about transfer pricing. So, what is transfer pricing? Which is a legitimate and good question. Simply, transfer pricing is the price of a cross-border transaction between two related, associated, or linked companies. And this transfer pricing should comply with what we call the arm's length principle. Means that the price that I will sell for a for a transaction between me as a headquarter and my subsidiary, or from my subsidiary to me, should be comparable to the price or to the interval of prices that can be found in many other transactions between two independent companies or entities, which means that transfer pricing it's a compliance tools. Like for me, and for the tax authorities, it's a compliance tools to measure the degree of compliance of multinationals, because multinationals, they are the groups that have many subsidiaries, and some subsidiaries can be established within some tax havens or within some kind of territories or jurisdictions with some advantageous tax rate, for example, Cayman Islands or in other places, and tax rate can be between 0 to 5%. So in order to try to frame this transfer pricing, we have what we call transfer pricing documentation. So in fact, to understand transfer pricing, you should read its documentation. Not documented, not done. And in this documentation, we're gonna try to compare between the documentation in Morocco and the other one in the United States. So we start from Morocco, and as of the financial law of 2021, there was more indicators about how the documentation should be done, and there is another we call the documentation threshold. Means that companies with the turnover over 50 million dirham or dirham they are obliged to do the documentation, and for the other one, they are less than this threshold, they are not obliged. And documentation includes at the same time master file and local file, with giving more indicator about that master file is more global. It concerns the group and the transfer pricing methods or politics or policy in the group, and the other one for the local file, it's more into the jurisdictions, like the company concerned by this tax control specifically, and then which type of transactions she does with the other associated companies, amounts, and also how she determines like the method of determining the transfer price, and etc. So as reading also the Article 214 of the Moroccan tax code, it also implies that those or both of those documents are obliged when there is a tax control. In order to know like what should we include in this documentation, and to understand really like how can we do the transfer pricing, because if we study in the theoretical part, we can see okay, transfer pricing, and try to give like its fundamentals from a tax point of view, from a legal aspect, from a financial aspect. Like is it like a tool of management, or it's just purely for tax purpose and so on. This is good, this is wonderful, but we should always come we should always be close to the how can we say, tax frame, accounting frame, and so on, like more into practice, in order to be in theory and like more of the philosophy of transfer pricing or the philosophy of tax. Like since the Magna Carta, when they said no taxation without representation and so on. And so we come back to our point. As we said, what can we include in this documentation, which depend of the how can we say, the personal work of the, the CPA or the auditor to to establish or to make their own way of how to represent master file local file, depending on the OECD. Like they publish documents, either they are purely from the OECD or they're coming from many collaboration with the FME and so on. So, for example, the master file, we can find some general description about the group and the entities and in which territory they are established, and we're talking about the general policy of transfer pricing of the group, and if the profit split, for example, and so on, which is used a lot in banking. When there's some international transaction between banks, financial things, and so on, rather than manufacturing or the commercial transaction or resale, for example. Then we can talk about tax regime for each one of the subsidiaries and giving more a functional analysis about like of the group and for each entity and like how they contribute in the making of the added value of the whole group. And for the local file, we're always talking in Morocco in this case. For the local file, we can introduce the industry, talking about some significant ratios and so on, and then presenting the local entity, the subsidiary, and like what she does, and like there's history and market. Talking about many we're talking about, for example, if there is a oligopolistic market and market structure, and like what like how like it's like giving a ID for the company, and then we talk about like the value chain, like from provisioning, or for example from sales, from purchasing to sales, and like if there is some work done inside, like we need raw materials and machine is done, and like the work or the human capital, also the intellectual capital, material capital investment, and so on. And then we can come up to giving a detailed description about the transaction between the linked companies, and then try to talk about the amount and giving like an overview of 3 years of the amounts of describe what kind of transactions between those linked between the linked companies, and as we said like before, amount, transaction type, and then we move on to the functional analysis, which is the base of everything, which is the real stone of our transfer pricing, because without a accurate and sufficient functional analysis, we cannot even prove how could we determine the transfer pricing method. And when we finish like the functional, we can add some financial ratios related to the comparable companies, because we need to see if we are totally we comply with the arm's length principle, and we are in the range of the transactions that were made by independent companies, because this is the first argument can be given by the tax administration during the tax control. And finally, we can do a summary to all of that, plus the appendixes. So this is kind of an overview about what we can see in the local file and the master file from my point of view, and from the things I worked personally within my internship. So like I didn't really do the master file. I just had an overview, but local file I assisted in making and revising one of the local files, and you can say that from a point of view, like a personal point of view, which is sufficient because you include everything you can, and like when there is a economy still undeveloped, like in the role of development, there is some kind of problems in finding some reliable evidence and some reliable data in order to create, or in order to draw your comparable panel and so on. But it says like each of the audit firms try to do the best in order to have the most sufficient and most, if I can say, reliable also transfer pricing documentation. If we compare this with United States, and like I'm quoting here from the American law, so there is no obligation of having local master file, but the, the American tax administration implies that transfer pricing documentation is not specifically required under some specific rules, but however, documentation created by the time taxpayer files its tax return that shows that the taxpayer reasonably used a specific or unspecified method to determine its transfer price can obviate the imposition of the transfer pricing penalty, which means that there is no obligation to do the master or local file, but when you are filling your tax sheet or taxpayer sheet, you should indicate which method you use, if it's like specified or unspecified, in order to avoid penalties. Because there is, in all cases here, some penalties when you don't provide like a good, reliable tax transfer pricing method, and which can goes off from 20% to 40% of the transaction, which is a higher amount to pay, and this can really jeopardize the entity, the entire entity. If you pay 40% of the transaction as just a penalty for transfer, it's not really a good deal. This is from the first point of view. Now, and the point of this comparison was just to give an overview about like more restricted obligation, for example, in Morocco, to do documentation, both files and so on, for companies that turn over 50 million dirham. And in the case of United States, the more developed companies, and it's like the business hub of the world, all along with Luxembourg, also Middle East now, and so on, which is more flexible. They don't try to oblige you to do the documentation, but when you fill in your taxpayer sheet, you should realize that you are in fact jeopardized to penalties, and you have to determine accurately the specific or specified or unspecified method you use for determine your transfer pricing price. And as we said, in all of the work, we should always comply with what we call the arm's length principle. Means that the price should always be comparable to price in transaction between two independent companies. So how can we determine this price or the transfer price? Generally, we're having methods coming from the OECD work. So first, what we call transaction-based methods, or in French, les méthodes traditionnelles. First, we have the comparable uncontrolled price, which is a method that compares the price charged for a property or service transferred in a controlled transaction to the price charged for a comparable property or service transferred in a comparable and controlled transaction. Uncontrolled means between either one of the companies, or between the company, an independent one, or between another associated company with an independent one, or between two completely independent companies in comparable circumstances. For example, I buy coffee with $100, but my neighbor, like, he buy it with $80.
and then I can like the tax administration can assume that like I'm trying to do some profits shifting. There is a 20% in addition, like I'm trying to give it to my subsidiary, which is located in a more advantageous aisle with the zero tax rate in order to accumulate my profit or my wealth there and not being taxed in my country with like with that 20%. And I'm trying to do some profit shifting by increasing or by overbilling the coffee, for example. The second method of those transaction-based method is the resale price method. So the resale price method is used to determine the price to be paid by a reseller for product purchased from an associated enterprise and resold to an independent. This means that there is in some cases resales. We are linked companies. I sell to the other linked company, and the other company doesn't do any manufacturing things. Just take the merchandise, or the thing that I sold, and it will sell with another margin to other independent customers or independent companies. So the purchase price is set to that margin earned by the reseller is sufficient to allow it to cover its selling and operating expenses and make an appropriate profit. If, for example, I am selling with a low price and I'm making some small margin, and the reseller, which is a linked company, makes a margin of 30%, 40%, means there is some base erosion from my part and from his part, and that's why the transfer pricing is not the price between the two linked company, but it's the price between the reseller and the other independent company or the independent customer. Which means that in that price, we're taking the same price from the sales took and from his sales, and there is we add the margin, like, because as a reseller, he did, for example, some insurance. There is some transportation. There is something that this margin can cover his expenses, but it should be comparable to arm's length principle, and that the other companies, another resale companies in independent cases, can have the same margin or something near to it. The third method in the transaction-based method are the cost plus, which is a method can relate to the analytical accounting. So it's used to determine the appropriate price to be charged by a supplier of property or services to a related purchaser. The price is determined by adding to cost incurred by the supplier an appropriate gross margin so that the supplier will make an appropriate profit in the light of market condition and function performed. I mean, it's really in the manufacturing area. For example, I'm making some chairs, so I can sum up all expenses or like what I spent in order to make this chair. Like I bought wood, and there is some iron and copper and many things that I'm doing, and like I'm summing all of this to make the chair, and I'm selling, and I'm having some profit margin, which is totally totally normal. So this margin, in all cases, should reflect also the arm's length principle, and I should always find my margin inside the interval margins that I took from some comparables transaction in a comparable circumstance. And the other type of transfer pricing method, which are not traditional one, what we call the inference limit or transactional, which are based on profit. Well, the first, that profit comparison method. We are comparing the margin that made from the net profit due to an appropriate base released from control product by reference to the net profit margin relative to some appropriate base realized from uncontrolled transaction, which means also it should be rely on or comply with the arm's length principle and compared to the interval margins within free market. And generally, this method it's highly used because it's easy to compare, or it's easy to try to justify the margin of the net margin, like from the net sales, rather than doing some transaction based methods. And the second one is the profit split, which means that we take the combined profit earned by two related parties from one or a series of transactions and divide those profits using an economically valid defined basis that aims at replicating the division of profits, and that would have been anticipated in an agreement by the arms. It means that, for example, I take the total amount of the transactions that made between two linked companies, for example, a 100, and I'm having some key division factors. For example, company A contributed with 60%, the other with 40%, and then I split like a 60 for the first one and 40 for the second one, and this it's kind of agreement, or those factors, those percentages, this 60 and 40% should always be within and comply with the arm's length principle. This is like mainly the method that are used in determining the transfer pricing of a transaction, of a cross-border transaction, in fact, between linked or associated companies. So, like, I guess we can stop here as the first episode, and in the next episode we're gonna be talking about more the transfer pricing aspects from a generally for the financial transaction of financing, and we're gonna do some analysis of the treasure function, which is really important, and then we can discuss like another aspect, and especially we're going to talk about examples in Morocco with more details, examples in Tunisia, in France, in Luxembourg, United States, UK, and also in Middle East, because it's like I see that there is a big development into transfer pricing. We can say transfer pricing law or provisions that like I'm following them today, and then like we can make like about 5 or 6 episodes that will be helpful to understand the transfer pricing from a general review. So I thank you for your attention, and to the next episode.